Good morning, everyone. Welcome along. We'll just give a couple more minutes or a minute or so while we wait for a few attendees to join, because we've just rolled around 10:30. Thank you for joining so far. Okay, a couple more seconds and then we'll kick this one off. So just bear with us for a few more seconds. All righty. Okay, in the interest of time, we will get things going here. Hi, everybody. I'm Guy Callaghan, the CEO of Banjo Loans. First of all, welcome to everybody to come along to this webinar. We're really excited to be hosting this webinar with Creditor Watch and Open Analytics. We've got a great team here, and I'll let Patrick and James introduce themselves now, and then we'll sort of kick off into the presentation. But thank you very much for attending. I hope you get a lot of value out of this session. Please ask questions in the chat if you've got any questions that come up, spark something off in you want to find out a little bit more. And then towards the end of the session today, we'll do a Q&A session. We appreciate everyone being on. We know webinars are getting tiring, but I think you'll find there's some really fascinating information in this one. Okay, Pat, maybe I'll get you to introduce yourself first.
Yeah, great. Thanks, Guy. Thank you for having us, of course, and thanks to everyone who's signed in, whether you're at home or in the office. There's plenty of hybrid models out there. My name's Patrick Coughlin. I'm the CEO and one of the founding employees at Creditor Watch. Creditor Watch is a commercial credit reporting bureau or agency, providing credit risk solutions to businesses of all sizes, from sole traders through to Big Four banks. And we've been working on this business risk index for quite some time, and I'm looking forward to being able to present it to you. I'll let James introduce himself and we can get into the detail.
Thanks, Pat, and thanks, Guy, for having us. So James O'Donnell, I'm the director of a company called Open Analytics, and what we do is specialise in all things credit and credit management. So primarily what we do is build credit rating systems and other credit decisioning systems for banks and other lenders. And of course, we've been working with Creditor Watch for about 2 years now. We've got quite a strong partnership, and the latest sort of thing that we've produced together is the Business Risk Index, which we're going to share with you today. All right.
Perfect. Yeah, we'll get you kick it off, James, and yeah, we'll have some questions as we go through, but looking forward to hearing about why you went about doing the Business Risk Index together and obviously the findings from it.
Great. All right, I'll dive straight into it. So look, before I start, Patrick might just give a very brief overview of Creditor Watch, and we'll focus on the data that Creditor Watch has available, which is behind the index.
Yeah, thanks for that. Yeah, look, Creditor Watch, we've got over 55,000 companies across Australia utilising us, as I said, from the smallest to the biggest. We're also accessing data from about 50 plus public, private and government data sources on companies, industry information, payment information, insolvency data, bankruptcy, anything that we can pull together to make a better prediction and to show, good, healthy, neutral and obviously high risk businesses out there. We're getting our hands on it one way or the other and putting that all together. And today we're obviously reporting on the Business Risk Index. And I think what's important to understand is that all that data that we're pulling in, you can pull a report or a score or a payment rating on an individual business, and that's the sort of bottom-up effect. And then what we talk about today is very high level, top-down, where we can say that these states are doing really well. These aren't. These are the 300 plus regions around Australia that we can report on in terms of you know, the potential for insolvency or probability of default in the future, and also looking at the various industries as well. So the data is ultimately the magic source in the index itself and in everything that we do, to be honest, at Creditor Watch. So quite keen to be able to show you some really interesting insights. And maybe if you just jump onto that next slide, James, you know, the business risk index itself has been a thought bubble of mine for probably, I'd say, I don't know, maybe 5 years, maybe even longer. It's something that comes up from time to time, and we were able to sort of combine my dreams, so to speak, with actually someone incredibly intelligent in James O'Donnell and his team from Open Analytics, who could actually say, Patrick, that's possibly, and we could probably do that. And once you had a look at the data, they were able to produce this incredible release and something that we release on a monthly basis, which is the Business Risk Index. You know, I probably came up with an idea, and James and the team at Creditor Watch, the engineering team, and of course the marketing team have put together this brilliant index, which is, as I said, looking at over 300 regions across Australia, essentially ranking them from, you know, 1 to 300 in terms of the best performing and the worst performing from a future insolvency risk perspective. And it's the sort of tool that is, one, I should say upfront, it is free. You can jump onto the website and have a look at it. So it's certainly not a sales process here. You jump onto the website, there's some beautiful interactive maps and graphs and whatnot, and you'll see some of that when James presents. But really, this is the sort of thing that can be used by, you know, the first cab off the rank would be, you know, anyone who's involved in offering trade terms. That could be, you know, trade credit, it could be finance, it could be insurance, for example, to understand and better assess risk. But also we're having great conversations with think tanks, with you know, investment and banking analysts, and also in particular a huge push into the government sector. You know, this we believe will be a really important piece of data for policymakers when it comes to, you know, what does the journey out of lockdown and the pandemic look like? What areas or industries need additional support? And then post-COVID, you know, when we're in that normal sort of routine again, where can we invest as a federal, as a state, as a local government? Where should we be investing to support growth? And where has that investment been successful? If we look back over the last 3 or 4 years, has that particular region performed better as a result of that investment? So it's a really, really powerful, multifaceted, beneficial piece of data that we're really excited to release on a monthly basis. And I think if I have it my way, James and his team and the engineering team will hopefully have a live index for us in the not too distant future, where you can go in and actually get live up-to-date data. So it's obviously pulling live data, but we're releasing it on a monthly basis at this stage. So James or Guy, maybe over to you.
All right, no, thanks for that preamble, Pat. So okay, so look, I'll explain a bit more what the index actually is. So number one, it's a new economic indicator, and what it measures is a future view or forward-looking view of insolvency risk at a regional level. So the way I like to sort of simplify what it is, it really, the best way to, a mental shortcut is to think of it as a regional credit rating. So what we're doing is effectively looking at the credit risk on average across about 300 regions within Australia. So you can sort of see on the heat map to the right, and as Patrick mentioned, it's all available online, so you can jump on and sort of look at the individual regions of interest. We've calibrated the model behind it on about 1.1 million regular ASIC PTY LTD credit active businesses. So it's very specifically designed on what we'd sort of regard as we filter out things like trusts and sole traders and just focus down on what we'd regard as quite a regular business. So a lot of data behind it. So when you think of a credit rating, you typically think of that as being associated with an individual business. And of course, it's a forward-looking view of the likelihood of a business going into default. By analogy, the index really is an average default risk for a region. So in practical terms, what that is, if you look at the little, the chart up there on your screen on the left, or the table there. So what we do is effectively assign a probability of defaults, or a PD, for each region. So that's our sort of forward-looking view of what's the percentage of businesses we expect to go insolvent over the next 12 months. And then what we do is we simply rank them from best to worst. So obviously best being the lowest PD or default risk. Then the index itself that we publish, to simplify it for the lay person, we put it on a simple sort of 0 to 100 scale. So it's what's sort of known as a rank index, and it's a ranking of PD. So more or less, if you get an index of 0, you're basically the highest risk region in the country. And at the other end, if you get an index of 100, you're the lowest risk. So sort of a normal business, so most businesses will sort of sit in the range between sort of 40 and 50. So 40 to 60, I'd say. So if you look at sort of the charts on the inset there, you can sort of see from left to right, that's sort of breaking the index and looking at a 4-year average default rate for the index into 10% groups or deciles. So sort of 0 to 10, 10 to 20, etc. In sort of practical terms, what we tend to say is if you're in the bottom 20%, so an index of 20 or less, but probably more realistically sort of within the bottom 30, so less than 30, you tend to be quite an elevated risk. Okay, so how do we build the thing? So look, it's all about the data behind it, and there really are fundamentally 2 types of data that feed into the index model. We've split the data into what we term as the more bottom-up or dynamic data, and that's more or less real time. That essentially gets updated daily, and that's all the CreditWatch data assets. That's sort of the most significant factor in the model. I'll call out sort of one key part of that data, and the most dynamic portion of that data is CreditWatch's B2B trade payments or transactional data. And that's where we're linking into accounts receivables and payment systems for CreditWatch's 50,000 odd customers. And at any given time, we're monitoring about 1 million businesses across Australia, and we're capturing things like their payments, arrears, and turnover, sort of your credit and debit turnover. So that's sort of the key sort of dynamic piece. Importantly, we've mixed that with what we'd term as more long-term or structural predictors. And they tend to change on a sort of longer time scales and sort of are more associated with a sort of long run insolvency risk. So there's a list there up on your screen, but I'll just call out sort of a couple of things. The most significant of these sort of more economic structural predictors is actually commercial rent prices. So for most businesses, the largest expense, sort of your commercial rent costs. Then more or less there's a range of different factors, but a lot of them correlate to measures of economic resources and wealth for the region. So things like median income, the index of economic opportunity, these tend to correlate to regions with sort of greater or lesser wealth and economic resources. So they're the sort of, I'd say, the 2 sort of main factors within the structural data. So we combine all that together into a dynamic model. We refresh it once a month, so we release new numbers every month on every region. And to get a sense of how we sort of think of this in practical terms and how to use it, this chart here sort of shows some of the back testing of the index. What I've done here is sort of grouped it into broad sort of 20% groups or quintiles. So each line on that chart there is a grouping of the index. So the top line there is sort of the less than 20, that sort of bottom 20% that I mentioned, through all the way to the end there, the sort of 80 plus down the bottom there. The vertical axis is a 1-year insolvency rate, and that's an insolvency or default rate sort of 12 months after the snapshot. So you can see there that what the index effectively does, it separates regions into a consistent ranking of insolvency risk over time. Okay, so look, that's some background on the index and sort of what it is and a bit about how we created it. Now we released it last month, and we've been sort of knee deep in all the data for about 2 months now, sort of digesting the results. So there's a lot there, and I'm sure we'll find more over the coming months, but just I'd say some sort of key call outs from what we've seen so far. Number one there, sort of regional areas quite significantly outperforming sort of urban and sort of city centre regions. And I'll talk a bit more about why that is. And some of it we think is sort of linked to, of course, the urban centres have been most affected by lockdowns, but there's certainly some industry factors in there as well. Effectively, there's some industries that are doing very well, sort of that tend to be situated in the regions. in terms of sort of the weaker performers and sort of the negative news, so we've seen quite a bit of deterioration in capital city CBDs, and more or less that's concentrated on the East Coast, so Sydney, Melbourne and Brisbane, which I'm sure is probably not too surprising to anyone who lives in any of those areas. I'd say we're probably a bit more pessimistic on Melbourne, seems to be hit a bit harder than the others. Then there are two real standout sort of black spots in terms of very high insolvency risks, and they're basically the Gold Coast and Western Sydney. So I'll talk a little bit more about those in a few slides' time. There's actually quite a bit of positive news on the flip side. So we're quite pleasantly surprised when we sort of went through this data. There's actually a lot of regions and areas that are performing quite well. So number one, and we released a number of economic case studies on this last month, but sort of agribusiness and farming areas. So we've sort of been digging into areas like Mackay, the sort of sugarcane area in Queensland, the WA wheat belt, and the Yarra and other sort of winery regions, both in Victoria, New South Wales and South Australia also are doing very well. The one we've been digging into this month is some of the regions sort of affected by the green energy projects. So two sort of big ones is sort of in Griffith, the sort of Darling Point solar farm. I think that's the biggest sort of solar project in Australia. The regions around that are performing really well. And in South Australia is a strong performer in general, but around that sort of the mid-north and sort of north of Adelaide, around where the sort of Hornsdale sort of wind farm has been developed around there. And then just finally, sort of the manufacturing regions, we're seeing a little bit of deterioration in the most recent quarter, but in general, the manufacturing regions are tending to outperform the rest of the states that they're within. So for example, Geelong in Melbourne is performing quite a bit better than Melbourne City and Melbourne urban areas. And lastly, more of a sort of a macro point, we think with sort of the steady reduction in insolvencies and credit defaults, which we've seen basically since COVID, and I think most people would agree it's a bit of an artificial effect from various government intervention. All the signs are that that's bottomed out, and we're likely to see the default rates kick up quite soon. So I'll show you a bit more on that in a few slides' time as well. Okay, so on the sort of forward-looking view of insolvencies, so this chart again sort of shows default rates. This time I've just simplified it and showed the national average in black in the middle there, and the top and bottom 10%. So I sort of highlighted the sort of pre-COVID world where everything was pretty flat, and probably surprisingly to most people that default rates actually went down over that period where JobKeeper was in place from about March 2020. What we've seen, that steady decrease is essentially artificially driven by a few things, but obviously the government's cash injection into businesses, but also creditors being very lenient. Whether it's both the banking, the major banks are all giving forbearance and payment holidays, and also the ATOs and enforcing tax arrears at the moment. All the signs, a lot of signs in our data saying that's about to tick up. So probably the good news is, as things get back to normal, we're expecting insolvencies to return to something around the pre-COVID levels. But we're not sort of seeing anything in the data that suggests a really ugly economic shock or really high insolvencies. So we're expecting it to lift sort of naturally over the next sort of 6 to 12 months. A bit of a state view. I always like showing this slide. It gets the competitive nature out, particularly between New South Wales and Victoria. But this chart sort of shows the PD, or probability of default, so what's behind the index at a state level. I've sort of just pulled out the major states here. So just a few things to call out. Queensland is consistently the sort of highest risk state, and that sort of deteriorated a bit over the COVID period. At the other end of the scale, South Australia is quite low risk, and a lot of that's related to basically the unusual combination in that state of high wealth population, so a lot of economic resources, disposable income, coupled with very low property and commercial rent prices, which you more or less don't see anywhere else in the country. So it's that sort of unique combination that keeps sort of South Australia as a low insolvency rate for businesses area. The other sort of thing that's happened is a bit of a convergence of, you know, particularly sort of New South Wales and Victoria. Historically, Victoria has been a lower insolvency risk state than New South Wales, and led by sort of the Melbourne sort of urban areas, we've really seen those two sort of converge. It's not that New South Wales has improved, it's sort of that Melbourne sort of, in relative terms, sort of, and Victoria's deteriorated more. So that's sort of a macro sort of view by state. Now, what we've learned sort of going through this process is there's actually a lot more within every state. There's quite high and low risk regions. So the more interesting data, I think, is when you dive into a bit more sort of a regional view. This chart sort of shows the way that we've been chosen to sort of visualize all the data on one screen, as it were. So I'll take a little bit of time to explain this graph. So this is what's called a bubble plot. So each point or bubble on the plot represents each one of those 300 odd regions. The size of the bubble correlates to the number of credit active businesses in the region. So for example, you can see Sydney CBD in the middle. There's the biggest bubble, is the biggest region there. Now the vertical axis is a backward looking view of last year's default rates. So what we saw last year in terms of annual insolvencies. The horizontal axis is the forward looking view that drives the index. So that's our view on sort of next year's default rates for each region. So basically, the further to the right you are, the closer your index will be to that 0 end of the scale, and the further to the left, the closer you'll be to the 100 end of the scale. So just to pull out a few of those regions that I touched on before. So if you look at the worst, the bottom 5%, or even the bottom 10 regions are all concentrated within either the Gold Coast or Western Sydney. So there's a few names there on the chart. So places like Southport, Oxenford, Coolangatta, Gold Coast North, all of those regions and a few others that I haven't called out there are all within the Gold Coast Shire. And the other big sort of centre is around sort of Canterbury, Bankstown in Sydney, and sort of the surrounding suburbs there. So I think it's probably a few differences there. With Western Sydney, it hasn't deteriorated too much with COVID. It's sort of more of a structural story of that sort of entrenched sort of a higher insolvency risk area. Whereas the same is true to some extent for the Gold Coast, but it's certainly deteriorated with COVID and border closures. And, you know, as you can imagine, that, you know, all the international tourism and cash flow from that, it isn't coming through. So probably not too surprising, but the data really sort of shows out how high risk that region is. This month we've actually been zeroing in on some of the larger regions. So it's actually interesting. Some of the lowest risk regions tend to be regional areas, which tend to have between 1,000 to 3,000 businesses. So we've sort of been filtering the world on, well, what about populations where, with larger populations and numbers of businesses. So this first chart is that same sort of bubble plot, but filtering on all regions that have at least 5,000 credit active companies in them. So probably the thing to call out here is the capital cities there. So you can see the Eastern Seaboard CBD, sort of Melbourne, Sydney and Brisbane, sort of clustered around that sort of about 6% default rate we're expecting over the next 12 months. Whereas Adelaide has been quite strong and Perth has been quite good as well. And then finally, just 3 more slides before I think we'll open it up to questions. If I sort of really filter down on the really big regions, so this time I'm sort of looking at 10,000 plus, and that really does tend to concentrate on the CBDs and urban centres. Seeing a lot of the larger population area best performers, there's a concentration in northern Sydney, so areas like Lane Cove and Ku-ring-gai, North Sydney, and then of course Perth City is quite strong as well in terms of the really big population centres. Then on sort of the weaker side, sort of Brisbane and Melbourne are on the list there, but Melbourne's probably deteriorated the most, or certainly over the last 12 months. And then you've sort of got Monash sort of in the suburbs of Melbourne. if I cut this chart on 5,000 plus, the relatively big areas, the bottom end does tend to be again dominated by those basically Gold Coast and that Western Sydney. So around that sort of Bankstown area is particularly high risk. And then in terms of movement, so we've started sort of tracking how the index moves over sort of quarterly periods. So this is basically the index goes up, you're sort of moving up the ranks compared to other regions. So sort of call out there is a lot of sort of suburbs in Perth and around Perth. So places like Stirling and Swan. Stirling is a bit sort of on the weaker side in terms of the overall index, but is improving. But in general, we're seeing sort of Western Australia sort of climbing the ranks. And then Brisbane, although it was sort of on the weaker side, is sort of improving quite a bit there. On the flip side, sort of the biggest sort of decline has been in sort of the suburbs of Melbourne, sort of Manning West within the sort of Melbourne suburbs. Then kind of interestingly, sort of Wollongong in New South Wales has gone down a bit. Geelong there in Victoria, it's actually an interesting one. They've deteriorated a bit in the last quarter, but if you look at a sort of longer view, Geelong is actually, in terms of its relative index, is quite a bit better than the average, and certainly quite a bit better than the average of Victoria. My last chart before I sort of open up for questions is one of our favourites and something we sort of keep a keen eye on, and this is essentially Creditor Watch's view of GDP, and sort of like a dynamic GDP, where we're actually taking all of our data suppliers and looking at their trade receivables, the total trade receivables, and we're looking how that's moving year on year. So it's like a trade receivables growth, and it's a proxy for business turnover. So where that number is positive there, that means businesses, basically the trade receivables are growing, so i.e. their turnover's up. You can see sort of even before the sort of COVID period, which I've highlighted there, the economy was, trade activity was down a bit, but you can certainly see in that sort of, that the period for which JobKeeper was in place, the big sort of hole in business turnover, that more or less the government sort of support was designed to sort of fill that hole. And from everything we've seen, it's done its job. Incidentally, Patrick mentioned that we've sort of been talking to government a fair bit about all of this data. We've been sort of sharing this with Treasury, sort of looking at policy around things like JobKeeper. At the time when JobKeeper was due to be switched off in March, we were actually all pretty optimistic, and it was looking like you can see that the turnover was starting to head north and head back to normal. And then pretty much straight away, the Delta variant kicked in, and of course don't have to remind everyone of the lockdowns we've all been sitting in for the last several months. So again, in the October numbers, it's weak again, but obviously that month is still pretty heavily impacted by the turnover, the lockdowns. Now look, we've been saying this for a while, but we're still sort of sticking to our guns. We're still very optimistic that that'll bounce back, and we'll be very surprised if this turnover measure really doesn't start to bounce back between now and Christmas. Look, I might leave it there. That's probably enough information. So happy to probably open up for questions.
All right, so I'll fire off we've got a couple that have come through. The first one is someone who's obviously quite technical. The PD model. Is it a multi-variable regression model? Now that's something I can't answer, so I'm hoping you can, James.
It's multi-variable, but not regression. So yeah, it's actually a bit of an iterative method. So it's sort of what's often called a mixture model. So probably the most interesting part of it is what we're doing with the Creditor Watch model, and it's a bit of an oversimplification, but what we're effectively doing is using all the data the Creditor Watch has. There's about 40 factors. We're essentially credit scoring every business and rolling that up to the regional level. The optimization method is a bit more complex than that, but that sort of component of the model is a model in its own right. And then we sort of mix together those. I can see the smiles there. I might have probably lost a lot of people.
Not saying anything.
But I would say we're going to release. We're probably actually going to release some academic papers on it, because there are some interesting methods. So one thing, both with Open Analytics and with CreditWatch as well, we're quite an open book in terms of our kind of methodologies. So we're happy to share detailed methodology papers with anyone who's interested.
Nice. Thanks, James. Look, actually did Lisa pretty interesting question what you said there. So I'd say there would have been a heap of info that you have gathered together that ended up on the cutting room floor. So is there any that you kind of wish you had included in this report? And then following on from that, what does the next rendition look like? Is there different stuff you're going to add, or where do you see it going from here?
I think it's. I might jump in first there, James, because I know you'll have your opinion as well. But it's actually a really good problem to have. We sort of the team looks at it and goes, wow, we can report so much just because there's so many great insights and graphs and charts and data that comes out of it. So it's probably more of a case of how much can we jam in without having people, without it going too long, right? I don't know what most people like, but my attention span is probably 20 to 30 minutes at best, and my wife would say it's even less than that. But it's a really good problem to have. But where it's interesting, I think it allows us to do different reports every month rather than talk about the same thing, which historically, if you look at any sort of index or economic release, it's fairly consistent in what they're talking about. We used to talk about just insolvencies, court actions, and what. But now we can actually look at different regions. We can talk about relevant sort of cyclical or seasonal events as well, and how that's affected various industries or the index itself. So it's actually nice to see different things coming out. James, you might have a different opinion.
Yeah, the way I'd answer that is the way we've sort of conceptualized this model. It's very much focused on the middle market, SME and small business. So I think what we'd like to do in the future I think would be an interesting exercise is filtering out that maybe top 5% turnover businesses. Let's say you're kind of 50 mil plus, and looking at more the financial data sort of index. So, for example, you can source financials from, at least from the ASX, and looking at how sort of, if you think of credit, you're typically looking at more behavioural and demographic factors for the smaller end of town. But once you get to the bigger end of town, you're probably more looking at the balance sheet, things like, turnover, profitability, liquidity, and things like that. So what's in my mind at the moment, as maybe a long way down the track, is actually building a similar index for the big end of town.
Yeah, I think this one's really fascinating because there's a lot of people who don't have this kind of data. You can get the publicly known data quite easily, but this one's fascinating, and I know we're quite excited about it here internally and looking at it and where we use it. All right, so there's a few more questions come through. So to what extent have border closures driven the deterioration in the BRI credit ratings and business in general, and what's the expectation for a rebound post borders reopening? Have you guys got some insights on that?
I was going to say we should have brought our economist along, so I'll answer that as a amateur economist. Look, I think with some of those Gold Coast numbers, I think it's obviously related to border closures. So that region has really deteriorated. It's actually interesting. If you look in areas in, say, Western Australia and South Australia, there's some tourism-driven areas that haven't deteriorated so much. So our sort of theory there is that they're kind of more driven by local tourism, whereas somewhere like the Gold Coast, I don't know the figures, but I imagine a lot of their typical revenue comes from overseas and interstate relative, would be a bigger proportion of their revenue. So I'd say in that particular case, to me, it seems, pretty common sense that that's had a big impact.
Yep. And I think if you look at even you start to look at an industry level, tourism, we know anything affected by tourism has been hurt. But trying to get I don't know what it's like in Melbourne, but trying to get a booking in the CBD for lunch at the moment is virtually impossible, which is a great problem at the end of the day. And it is certainly picking up every single week. It still feels Mondays and Fridays are a bit slower, but there's more and more people out and about, which is great to see.
Yeah, it's definitely picking up here. And James hit on a very good point. In a week or two's time, we're doing our own economic update with a economist from a major bank. So join into that one if you can, guys. It'll be good insights on when things are opening up. One or two more questions. And this one sort of combined on a couple is just that outlook of where we're heading. But also, you guys been monitoring, your forecasts versus actuals and how you've performed over time. Also, will you be tracking that type of information?
Yeah. That's a big part of. I mean, ultimately, a model like this, the whole point of it is to predict defaults. So what we have seen, however, is that more or less there's artificial. So if we look at our predicted PD in the smack bang in the middle of the COVID period, it's actually quite a bit higher than the default rates, basically because there's levers in there. If the ATO isn't enforcing, tax debts, if banks are effectively not enforcing their kind of bad debts there either. So what we expect to see is what you see in the data is they track very closely the predicted and actual until the lockdowns and JobKeeper, and then you've basically got a big sort of drop in default rates, but we're already seeing them start to close up. So so we track that. The other thing with this style of model, what they do most effectively, I would say, is that sort of rank ordering view of the world. So no matter what sort of external shocks happen, they'll tend to always sort of reliably sort of order regions by relative risk.
Yeah. And I think on top of that, just to delve a bit further into the banks, the big, the major banks, and also the ATO, the expectation from our perspective, having spoken with either the banks or people in government, is that they won't get back to their sort of pre-COVID, wind up levels until mid next year. The banks will likely go a little bit earlier than the ATO, but they're certainly not about to, slam the brakes on the economic rebound or be seen to be slamming the brakes on the economic rebound as well from a PR perspective. So while insolvencies, for example, are down, 40% almost on average since the pandemic hit, since April 2020. They've got to come back to that level eventually, if not slightly higher, of course, because there's plenty of businesses out there that have been really affected, and we sort of see that happening middle of next year.
Yeah, look, we're probably the same. So it's been quite fascinating for us watching it, because we obviously deal with a lot of SME businesses, and I think we are witnessing a real W-shaped recovery as the two major states now start to come back into the play. It's a shame it wasn't a V shape, but pandemic's just has caused that. However, 2021 we didn't find as bad as 20, but now what we're finding, and I'm sure this will come through, and everything is those those insolvency stuff that were there are going to have to play out. There's a lot of government incentive money that's still just washing through the system now, which will play out. But the thing I think we're finding at the moment is things like supply chain issues that are really causing people to plan not months ahead, but 12 months ahead, a year ahead, which is and the tight employment market. I don't know about you guys, but even us personally, we're feeling the pinch on that one.
Yeah, definitely. Guy, can I ask you a question? Sorry.
Yep, go for it.
Is that all right? Just off the back of the results that James has spoken through, how does that sort of correlate to what you're seeing in the lending market? Because it feels like, correct me if I'm wrong, but you say 2020, basically a lot of businesses just went, even if I'm in a huge amount of trouble and I've got no revenue coming in, I don't want more debt. But that seemed, is that sort of turned a bit?
Yeah, it's really interesting. Exactly that. We've started to see some really good green shoots of recovery for the last few months. I think, as I mentioned, I think there's still some of that government incentive money to wash out, because there's a lot of businesses whose balance sheets were very healthy and they got rid of some debt, and now they're starting to come through the other side. We're really happy with what's happening with the rebound. However, I think people are still being a little bit cautious that lockdowns won't come back, and that where things are going and just how engaged the consumers are going to be to spend. So there's a little bit of caution there, and of course these supply chain issues are really hurting things like that. With the regions, yeah, the tourism regions, yeah, they're finding it really tough. As you can imagine, the Queensland ones really resonate with us. Starting to get a little bit of, when the vaccine rates get up, you start to see the light at the end of the tunnel for a lot of businesses, and they start to come back again, which is really positive. But yeah, thanks for that. Look, with those the governments and industry interests, any idea on how they're planning on using this information? Because there's some really good stuff there.
Yeah, look, it depends. Each government department or individual that we speak to has a sort of different lens on it. You know, that they might have their own I'll say selfish outlook. You know, they're looking at their own constituency and saying, how can I utilize this data to potentially get more funding or promote how well I've done. Whereas if you look at a treasury perspective, they're really delving into they want to see the data, the physical data behind, you know, the models and be able to utilize that themselves within their own models too, and get a better understanding of, you know, how successful is JobKeeper. You know, when can we, you know, start to turn the stimulus taps off? Do we need to keep them on a little bit longer? You know, what particular regions are hurting or industries? And then hopefully they can utilize that to be a little bit more targeted with their stimulus going forward. You know, there was plenty of talk beginning of this year saying, you know, we're going to turn JobKeeper off, but certain industries like arts and rec or tourism were saying, yeah, but we need targeted JobKeeper for, you know, tourism keeper or something like that. So yeah, I think there's different ways. James, your thoughts?
Yeah, I'd agree with that. I mean, in some sense, it's simple. We're pointing out regions that are booming and regions that are, well, probably more regions that are struggling. So I think, you know, there's probably natural ways that governments can, you know, help those regions. So
yeah, cool. All right, just in the absence of time, I'll do one more question that we've got from the panel, and then just I know webinars 45 minutes seems to be the time for most people in here, and it sort of probably dovetails quite well with what we're talking about. With the absence of information from the ATO about tax debt, how does that affect the model, or does it?
We would love to have that data. I think we soon will. Well, Pat, you've been involved in those discussions.
Yeah. Yeah, that's right. We've been, at Credit Watch, we've been lobbying the ATO for probably longer than I had a thought bubble around an index. So I think trying to get them to release that information, because, you know, I'm sure you've seen it. I'm sure plenty of businesses out there have seen it, where they're trading well with a debtor, and then all of a sudden the debtor falls over, it goes into administration. You get the creditors list, and the ATO is at the top with this huge, you know, 50,000, 100,000, 500,000, whatever it is. It's by far the largest debt, and it's been outstanding for a long time, and it's been accumulated for a long time. And every creditor throws up their hand and goes, well, if we knew that, we wouldn't have exposed ourselves. We would have halved our exposure. We would have dealt with them on a COD perspective. And you know, there's obvious sensitivities to releasing that data, because the government, you know, can look bad, and, you know, they don't want to be seen as hammering businesses that don't pay their bills. But at the end of the day, it has that knock-on effect to all the other suppliers. So the ATO is actually going to start sharing that data with Creditor Watch. We're expecting to start getting defaults through this month. What's been really successful for the ATO is that they've been telling businesses, if you don't do it, you know, we'll register a default against you on Creditor Watch, for example, and they're actually getting paid. So it's been a really good collection tool for everyone. So we should all be happy as taxpayers that the taxes are being paid. From a Creditor Watch perspective, we obviously want to get our hands on that data and be able to utilize it, not only, you know, to be able to see it in an individual report when you're assessing an individual business, or you're monitoring them, and we send you an email alert to say, hey, there's a $100,000 tax debt default that's been registered. But starting to include that into the index will be incredibly powerful. So yeah, keep an eye out for more information on that, guy.
Yeah, okay, that's fantastic. That's really good, actually. Look, actually, just on the note, so as we wrap up, look, Gee, there goes my alarm. So as we wrap up, look, just probably a reminder that this is a free tool for everybody to be able to access. So I know we've got a lot of financial participants on the call. We've got brokers and accountants and people in the financial market. So please, this is a fantastic tool. We actually use this type of info all the time. We've been pretty excited to receive it. And what it does, I think, is it actually matches what we're seeing in the market, but it's really backing it up with the data. The stuff around the trade receivables is invaluable type of information. So everybody's on the line. Please, jump onto Credit Watch and have a look at this tool.
I'll just add there as well that we the October results. So everyone who's listening here and anyone in that Banjo sort of subscription gets it a day early. So the website creditorwatch.com.au/business risk index will update tomorrow with the October results. So in there at the moment is September. Press release goes out out of embargo at I think tomorrow morning. So if you check today, you'll see September, but if you come back tomorrow, you'll see October as well. But thanks for that plug, Guy. I appreciate it.
Yeah, hot off the press. There we go. All right, guys. Look, first of all, thank you very much, Patrick and James, for sharing this information and for sharing with the audience. Big thanks to everybody who's come in on the call. We will share this a recording of this via LinkedIn. But yeah, look out for the Creditor Watch paper and get on there tomorrow and see October's numbers. Any questions, please still just send them through and we can try and get back to them later. But thanks everybody for being on.
Thanks for having us. Really appreciate it. Thanks everyone.
Cheers, guys.